All right, welcome back to investments, asset pricing, okay, chapter 7, okay, and so we ended chapter 6 with a discussion about Markowitz's modern portfolio theory, okay, and Markowitz's key contribution is the concept of the efficient frontier. And the next step in the development of portfolio theory is asset pricing or valuation theory that was created by Bill Sharp, another Nobel Prize winner. So Markowitz won the Nobel Prize, and then Bill Sharp won the Nobel Prize. So Sharp begins by looking at the effect of combining a risk-free asset, like a treasury bill, into a portfolio of risky assets. So he started thinking, what happens if we include a risk-free asset into a portfolio that already has risky assets? And so remember the efficient frontier, which is the optimal combination of assets, risky assets in a portfolio. Okay, so what happens if we add to those portfolios a risk-free asset? All right, so the risk-free asset is usually a T-bill or a treasury bill, which is a short-term debt instrument of the U.S. government, and it has no variability of return. Okay, and that means the standard deviation of the return is 0, and that means you actually earn what you expect to earn, so there is no uncertainty about the return. This is why it's considered to be risk-free. All right, in addition to having no volatility, the treasury bill has 0 correlation with other assets. It doesn't move with other assets. Okay? So lastly, it does provide, this treasury bill, a positive risk-free rate of return. So it has no correlation, no variability, and it contributes return, positive return. Okay? So to add this risk-free asset into the efficient frontier graph that Markowitz came up with, okay? So here's the efficient frontier here. And again, this is deep theory, but we're going to come to some simple conclusions that we can use as we think about portfolios and investing for individuals, how we manage our investments. So what we do is we move up the y-axis here, which is expected return, until we hit the risk-free rate of return, which is the yield on treasury bills. Once we hit this point, we then draw a line that drops down here and makes contact with the efficient frontier, the Markowitz efficient frontier. Okay? So this is called the tangent line that goes from the y-axis, expected return, out and makes contact with the efficient frontier there at point M. Okay? And this line is called the capital market line. The capital market line. Okay? And the slope of the line, how steep it is, steep, flat, okay, represents the price of risk. It's the risk premium. Okay? So how much additional expected return, risk premium, is required to justify assuming additional risk? In other words, the steeper the line is, the more return we must pay in order to go out farther on the standard deviation or risk line. So each increment, additional increment of standard deviation with a steep slope requires more return, and if it's flatter, taking on more risk does not require as much additional return. Okay? So the expected return of this portfolio, which includes the risk-free asset and the risky asset, is the expected return of the risk-free asset times the weight of the risk-free asset plus the expected return of the risky portfolio times the weight of the risky portfolio. So it's the weighted average return, and you've seen this in other calculations that we've done. However, the expected standard deviation, so first we're looking at expected return, now we're looking at expected standard deviation of the portfolio. It is reduced to simply the proportion of the total portfolio invested in the risky assets. So we're going to exclude the percentage of the portfolio that we put in the risk-free asset times the expected standard deviation of the risky assets. Okay, so the weight of the risky assets times the standard deviation of the risky assets. We're going to ignore the risk-free assets because there is no standard deviation. Okay, so the standard deviation of the risk-free asset is not included, and this is because the risk-free asset has no standard deviation. Okay? All right. The point of all of this is that by combining the risk-free and the risky assets, the expected standard deviation, which is the volatility of the portfolio, the total portfolio, will decline further than the expected return of the total portfolio will decline. So the addition of the risk-free asset will drop the standard deviation much more than it will drop the return, the expected return of the portfolio, thereby giving us a more efficient portfolio. Okay? So investors add the risk-free asset to their portfolios to reduce risk by more than they reduce returns. And because the portfolios that include risky and risk-free assets have superior risk-return profiles, portfolios without some exposure to the risk-free assets are suboptimal on a risk-adjusted basis. Therefore, adding the risk-free asset creates a new dominant efficient frontier. Okay? And this new efficient frontier is called the capital market line. So Sharpe started with the efficient frontier, then added a risk-free asset, and found that he could create a new efficient frontier that included the risk-free asset that had a better risk-return trade-off than the Markowitz efficient frontier, and they call it the capital market line. So we're going to stop there. So we're developing this theory of portfolio valuation, portfolio pricing that started with Markowitz and then went to Sharpe, and we'll flesh this out in the rest of this chapter. So we're going to stop there, take a quick break, and then we'll come back with the next clip. Until then, I bid thee peace out, shalom.